Good day, Junior Tickies. We are going to look at Chapter 7, Activity 8. Required, we are going to look at question 8.1 up to question 8.3. You are provided with an extract from an audit report and information B, after processing all the adjustments, they provided you with current ratio, the total inventories, and what is the total current liabilities. Take note of how financial indicators can be incorporated in audit reports. So question 8.1, refer to point number 3. What type of audit report did the company receive? So if we look at point number 3, because of the significance of the matters described above, we do not express an opinion. We do not express an opinion means that this is a disclaimer, which means it's a disaster. No company wants to receive this type of audit report. Question 8.2, refer to point number 1. Point number 1 says, we were unable to obtain sufficient audit evidence to support the amounts provided for certain income and expense items. So the question says, give examples of audit evidence that the auditors would have required regarding this problem. So if we look at examples of audit evidence, there must be asset registers, journals, debtor statements, physical inspections, contracts must be signed, source documents like invoices, ledgers, creditor statements, bank statements, EFT vouchers, proof of payment. So these are all examples of audit evidence. Question 8.3, refer to point number 2. So if we look at point number 2, furthermore, the repurchase of shares on 30 January 2022 is not in accordance with provisions of the Company Act, as the liquidity of the company has been compromised. So the question says, apart from the current ratio, identify and calculate one other financial indicator that the auditors would have used in deciding on this opinion. So another option that we can look at is the asset test ratio. And let the information guide you. They provided the current ratio. They provided the total inventories. If we look at the asset test ratio, the asset test ratio is your current assets minus inventories, or it's your trade and other receivables plus cash and cash equivalents divided by the current liabilities. So based on the information presented, we first need to find out what is the total current assets equal to, so that we can subtract the inventories. So to find that, because the current ratio is given to you 0.8, we are going to take the current liabilities and we're going to times it by 0.8. That will provide us with the total current assets. Current assets minus inventories divided by the current liabilities equals 0.42 to 1. Remember that your ratios should always be to 1. So this shows that the company will not be able to meet their short-term obligations. Next part of this question, explain what the directors could have done to prevent this comment by the auditors. So if we look at this, cash in the investments, postpone the repurchase of shares to another time when the liquidity improves, ensure that auditors and directors comply with the Company Act. Try to convince the auditors that the solvency ratio is good. Solvency ratio, does our total assets exceed our total liabilities? issue more shares to the public or existing shareholders, offer rights issue to shareholders rather than to pay more dividends. Company offers higher dividends to shareholders rather than repurchase of shares. Reduce the dividends paid to improve liquidity. Promote more cash sales or offload stock. So those are all possibilities that the directors could have done to prevent that comment by the auditors. Thank you very much. I want to leave you with this quote. The secret of your success is determined by your hard work and strong focus on your goal. Next, we're going to look at the last activity, activity 9. I hope you have a wonderful day.